This is one of our annual symposium chat. Donald Trump criticizing the Fed, Jay Powell and his colleagues making a very important decision in just a couple, 3 weeks about whether to cut rates again. What does this mean? Is this something they just shrug off, or does it really impinge on them somehow?
Well, to begin with, I don't believe that the President of the United States should intervene and interfere in such a way in the conduct of monetary policy. The Federal Reserve has had a spectacularly serious, responsible record, and they know what they are doing. So obviously it is not helpful, and knowing Chairman Powell and the rest of the committee, I believe that they will continue in their professional analysis and make the decision based on data, based on analysis, and really shrug it away. The problem is not what they do, but how the markets interpret this kind of an intervention. But the more there are such interventions, the more the market will realize that they are ineffective.
Uncertainties caused by global developments. That's the Fed speak way of saying the trade war. And of course, it got a little bit worse, didn't it? Just the day after the Fed cut its key rate. On August 1st, President Trump tweeted out that he's putting more tariffs on China. That's when the market started going crazy. When you look at the economy and the need for the Fed, I think, as they did at the last meeting, to take out an insurance cut because they're worried about that, is the situation still with us as we look to the September meeting?
Well, to begin with, it is indeed a huge amount of uncertainty in the market, in the background to the Fed's decision, and most of this uncertainty is coming from either the trade war or developments in Europe, the decline of China, the recession in Germany, Italy, Brexit, you name it. All of those things cannot be and should not be expected to be handled by monetary policy. The trade war is a very important element because it affects sentiments of the business sector. If you look at the business sector and you ask them, how is your sentiment, they will tell you that the trade war or the uncertainty that emanates from it is affecting them in a very negative way. This is why when you look today about what holds the U.S. production in general, you will see that services are reasonably okay, but manufacturing is not okay. Business investment is not okay. And why? Because of the fact that there are these degrees of uncertainty. After all, the tax cut on the corporate sector did make a very positive move for the business sentiments. So why to spoil it? Now, you're talking about the next Fed meeting. The next Fed meeting is not tomorrow, and it's not the day after. It's in September. The Fed has made a point of having their decision data dependent. What's the point of announcing today what do you think will happen to interest rates when you know that there is still a lot of data to come?
So in other words, you think Jay Powell will be very cautious in that speech tomorrow?
Well, he should be cautious, and in fact, most of his messages in the past presentations emphasized the issue of caution, issue of going slowly, issue of data dependence, and things of that type. And so why to rush?
Well, because you just talked about a recession in Germany. There's a slowdown in China. There's so many things going on. Would it be prudent for the Fed? And do you think the Fed will cut the key rate on September 21st?
Well, there are two questions. What the Fed should do and what is the expected decision of the Fed, which is basically forecasting what members of the FOMC will decide. By counting heads, it looks like that there are a lot of sentiments to cut rates by 25 basis points. But I would urge everyone to listen carefully to the arguments of those who are more skeptical about it. They have serious arguments. The fact of the matter is that when you look at the toolkit of the Fed today, it is not equipped very well to deal with the next recession. When interest rates are so low, even in most of the many parts of the world going to be negative, this is not the place where you want the most important instruments of monetary policy to be. Where will you go? So you are talking about guidance, you are talking about buying assets, you are talking about this and that, all of the things that we defined yesterday as unconventional. You want to make them conventional? After all, they are not as effective as the most important instruments. So when you talk about insurance against the next recession, I also talk about insurance, about having ammunition as you go to the battlefield. So those are issues to be settled, and I trust that the Fed in its wisdom will settle it. But it's not through pressures. But let's face it again, we talk about the Fed, we talk about monetary policy because we are in Jackson Hole. The elements in the markets today are not determined by the Fed. Not the Fed will generate world growth. It is the elimination of the uncertainty of trade war, of things that are self-inflicted. Just look what Smoot-Hawley did in the 30s. Don't go this way.
But you know, this increase in negative bond yields, which is over $16 trillion now. 5 years ago, there were none. It started picking up, and it's quite large now and seems to keep growing. And we had Germany just sell the government a 30-year bond with a negative coupon. What's driving that?
Is this normal?
Doesn't sound like it to me.
Doesn't think like it to me, and doesn't think like normal to anyone. So therefore we should ask ourselves, how do we get out of this syndrome? And we need to get out of this syndrome by activating other elements of economic policy, by increasing productivity, by making innovations, addressing growth issues, competition issues, things of that type, openness, globalization, stop this silly trade war. You are really shooting yourself in the foot.
So I'm also wondering about the financial services industry and that whole, the monetary transmission mechanism. One of them is through the banking system. In a world where we've got certainly the trade war, but just this move towards negative yields and ever lower yields, how does that affect the effectiveness of monetary policy or go against its effectiveness?
It's clearly going against its effectiveness. Monetary policy operates or transmits its impact on the economy through the financial industry. You need to have a thriving, robust financial industry for this transmission to take place. There is nobody in his right mind that would think that low rates or negative rates or zero rates is something that strengthens the financial industry. In fact, it makes the system much weaker. Most of the crises that we have had recently came from the financial sector, came from bubbles, came from overexpending the financial investments of people rather than investing in plant and equipment, by distorting the incentive system, by mispricing risks. All of those kind of things clearly are not good. When interest rates are very low, the most important discipline that drives out zombie firms is gone, because zombie firms can continue to finance themselves with low rates. This is not good for the economy. So I come again and again by saying the negative rates is not good. On top of it, people say that the inverted yield curve, namely long rates that are lower than short rates, is a signal for a sure recession. I am worried when I see that inverted yield curve, but by the same token, I want to argue that when the yield curve is inverted as a result of a rising short-term rate, it's a very different story than when it is inverted in the context of a lower short-term rate. And we should not really jump into the conclusion of this indicating a recession, because one of the reasons why long-term rates are so low is that people are shifting their investments towards that end because they cannot do anything in the short term. And don't forget, the balance sheets of the central banks is loaded with long-term assets that they purchased earlier. And therefore, this also contributes to a lower long-term rate.